Hello audience, welcome to Accounting School. Today we will discuss about International Accounting Standard 1, presentation of financial statements. IAS 1 will be presented in two parts. Today we will discuss part 1, where we will discuss regarding the history and background of IAS 1, objective and scope of IAS 1, and some terminology and general features. History and background of International Accounting Standard 1. To know about the history of IS 1, we needed to go back in 1974 when an exposure draft regarding disclosure of accounting policies was proposed, and in 1975 IS 1 disclosure of accounting policies was issued. And later on in 1977 IS 5 information to be disclosed in financial statements was issued, and in 1979 IS 13 presentation of current asset and current liabilities was issued. And then 1994 IS 1, IS 5 and IS 13 was reformatted, and on this alignment in 1997 IS 1 presentation of financial statement was issued. In 2001 IS 1 presentation of financial statements was adopted by IASB, and after that several amendments was made. From them major amendments was made in September 2007, June 2011, December 2014, and October 2018, January 2020, and October 2022. And some amendments are under consideration. These are primary financial statements, disclosure initiative regarding accounting policies, and classification of debt with covenant as current and non-current. And there was several interpretation regarding this IS. SIC 18 consistency alternative method, IFRIC 17 distribution of non-cash asset to the owner, SIC 27 evaluating the substance of transaction in the legal form of lease, and SIC 29 disclosure, service concession and arrangement. And regarding the amendments, if you want to say the last amendment which is made in 31st October 2022, which was regarding the non-current liability with the covenant, which will be effective from January 2024. And before that, regarding the classification of current and non-current liability, there was an amendment which was made in January 2022. And in 2018 October 2018, in the month of October, the definition of material was changes. Definition of material was changed. And before that, in 2014 December amendment by disclosure initiative, in 2011 June amendment for the items to be presented in other comprehensive income, and in September 2007 amendments to the presentation owner changes in equity and comprehensive income, and changes in terminology in the title of financial statements. The objective of International Accounting Standard 1, the presentation of financial statement, is to prescribe the basis for presentation of general purposes financial statement to ensure comparability both with the entity's financial statement of previous period and with the financial statements of other entities. IS 1 set out the overall requirement for the presentation of financial statement, guidelines for their structure, and minimum requirement for their content. In addition, the objective of general purposes financial statement is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. To meet that objective, financial statements provide information about an entity's asset, liability, equity, income and expenses, including gain and losses, contribution by and distribution to owners, and cash flows. That information, along with other information that is prescribed in the notes to the financial statement, assist the users of financial statement in predicting the entity's future cash flows. And in particular, their timing and certainties. Scope of IS-1. IS-1 applies in preparing and presenting to all general purposes financial statement based on the International Financial Reporting Standard. Other than IS-1, all other IFRS and IAS are set out the recognition, measurement and disclosure requirement. If we want to know the general purpose, what is general purposes financial statements? General purposes financial statements are those intended to meet the need of users who are not in a position to require an entity to prepare report tailored to their particular information needs. Now we will discuss regarding the terminology and general features. First of all, fair presentation. We all know the financial statement must present fairly the financial position, financial performance and cash flows of an entity. Fair presentation requires the faithful representation of the effect of transactions, other events and conditions in accordance with the definitions and recognition criteria of assets, liabilities, income and expenses set out in the framework. The application of IFRS with additional disclosure when necessary is presumed to result in financial statement that achieved in fair presentation. And the 2 points needed to keep in mind regarding the fair presentation that an entity shall not describe the financial statement as complying with IFRS unless they are comply with the all requirement of IFRS. And an entity cannot rectify the inappropriate accounting policies either by disclosures of accounting policies used by or by notes or explanatory material. As well as an entity can depart from the requirement of IFRS in which management concludes that compliance with the requirement of an IFRS would be so misleading that it would conflict with the objective of financial statement set out in the framework. It shall disclose in that case it shall disclose that management has concluded that the financial statement presents fairly the entity's financial position, performance and cash flows, that it has complied with the applicable IFRS, except that it has departed from a particular requirement to achieve the fair presentation. The reason why IFRS treatment would be so misleading: for each period presented, the financial effect of the departure on each item in the financial statements that would have been reported in the complying with the requirement. Now, going concern. An entity shall prepare the financial statement on a going concern basis unless management either intended to liquidate the entity or cease trading or has no realistic alternative but to do so when there is a significant doubt upon the entity's ability to continue as a going concern. The entity shall disclose those uncertainties. Accrual basis of accounting. An entity shall prepare its financial statement except for cash flow information using the accrual basis of accounting. Materiality and the aggregation. An entity shall present separately each material class of similar items, items of dissimilar nature or function unless they are immaterial. An entity shall not reduce the understandability of its financial statement by obscuring material information with immaterial information or by aggregating material items that have different natures or functions. Now, offsetting. An entity shall not offset assets, liabilities, income and expenses unless required or permitted by IFRS. An entity reports separately both assets and liabilities and income and expenses. Obsolescence allowances on inventory, doubtful debt allowances on receivable, foreign exchange gain losses or gains and losses arising on financial instrument held for trading is not offsetting. However, an entity presents such gains or losses separately if they are material. Now, the frequency of reporting. An entity shall present a complete set of financial statement, including comparative information, at least annually. When an entity changes the end of its reporting period and present financial statement for a period longer or shorter than 1 year, an entity shall disclose in addition to the period covered by the financial statement. The reason for using a longer or shorter period and the fact that amounts presented in the financial statement are not entirely comparable. Normally, an entity consistently prepares financial statement for 1 year period. However, for practical reasons, some entities prefer to report, for example, for a 52-week period. This standard does not preclude this practice. Then, comparative information. We will discuss the comparative information by segregating in two parts. One is minimum comparative information, which is mandatory. Every entity is required to maintain this requirement, and some is additional comparative information. For minimum comparative information, except when IFRS permit or require otherwise, an entity shall present comparative information in respect of the preceding period for all amounts reported in the current period's financial statement. An entity shall present as a minimum two statements of financial positions, two statements of profit or loss, and other comprehensive income, two separate statements of profit or loss, two statement of cash flows, and two statement of changes in equity and related notes. And then what we need to additional provide additional comparative information in the financial statement. This comparative information may consist of one or more statements referred to in paragraph 10, but need not comprises a complete set of financial statement. When this is the case, the entity shall present related note information for those additional statements. However, the entity is not required to present a third statement of financial statement, a third statement of cash flows, or a third statement of changes in equity. If you have any questions regarding this discussion part, you can ask me in comment box. Thank you for watching this video. You are requested to subscribe this channel to get more video on accounting. Thank you.